Hey traders, I'm Legado, market insights commentator at Global Prime Forex. As part of my daily educational delivery, I want to talk about the month-end Forex rebalancing flows that we've seen in the last London fix at 4 p.m. to be precise. Now, I really believe that this topic is going to be very fitting based on the movements that, as I said, we saw in the last 24 hours, especially benefiting the euro and the pound. You can see here the performance of all the currency indices, and in magenta we have the pound. It did explode higher, and at the same time the black line, that's the euro, it did move considerably to the upside. Okay, now as I stated in today's the Daily Age report, trading the currency market means that we are getting involved really in a complex of it's a web of intertwined factors that are going to be, to a lesser or a greater degree, are going to determine valuations in a particular currency. However, and that is very important to bear in mind, as we approach the month end, there's going to be special elements that are going to be at play. And what I'm referring here is this month-end rebalancing flows. That's a phenomenon that is very peculiar, and it happens at the end of the month and at the end of the quarter. And what we saw on Thursday around the 4 p.m. London fix, which is the time when these flows are going to be felt the most, essentially is this phenomenon at play. Okay, so what happens here is that usually portfolio managers will either leave or give orders to dealing desk to transact all these at times very heavy positions at the fixing time and the price that they have specified. And as I said, 4 p.m. London fix is one of the most is kind of like the benchmark time for these transactions to go through the books. Now this is going to result at times in fairly punchy movements that don't really necessarily have neither a technical nor a fundamental logic, but rather is all about tweaks in currency risk exposure by these global portfolio managers. And as I said, that's precisely what we've seen in the euro and in the pound. These are the currencies that have been benefiting the most. Now, the latest episode of these Forex rebalancing flows that have benefited the euro and the pound was a function really of just essentially global portfolio managers having a need to readjust their benchmarks for currency hedge ratios as their portfolios experience value variations during the month. Now, these flows can be, as I said, at times can be very heavy at the end of the month, and particularly heavy, even heavier, I would say, at the end of the quarter. Okay, this was April, what we just saw, so this is like the first month of the second quarter. Now, a common perception, and if my experience is any indication to go by, is that portfolio rebalancing at the end of the month is going to generate large, but most importantly, it's going to also generate unpredictable market movements in FX. Okay, and it's really hard to be modeling the expectations of these currency movements. Okay, all right, so let's keep moving forward. So as a rule of thumb, what you really need to understand is that as part of a basic model to gauge these flows, we could be looking at the change in equity performance by market capitalization, and then just simply adjust this for monthly FX spot movements. This is the way that most of the global portfolio managers are going to be looking at the data to adjust their currency hedge strategies. Now, this is going to give this, very important indication of how the value of an asset has changed over the course of the month, and therefore the extent of the portfolio rebalancing that is going to be needed to take place at the end of the month. Now, as a practical example, I know that it's getting a little bit complex here. Let's just say that the US equity market, in this case as expressed through the S&P 500 in this second chart, outperformed the European market, and here we have the DAX, okay, as a reference. Now, the actual performance was from low to the top, 22% in the S&P 500, and then it was 20% in the DAX, even though the close, on a closing basis, it's been adjusted lower for both. But for argument's sake, I really want to make the following example, which is going to be actually much more simple in nature. And remember that this is going to be very simple, because at the end of the day, we also have to account for the weighting that someone has got in the Nasdaq, in the Euro stocks, on other major benchmarks. So it would be preposterous to think that someone out there can actually understand what's the composition of when aggregating all the global portfolio managers. But the point remains here, which is for educational purposes, you know that the root cause of these erratic movements towards the end of the month is going to be Forex rebalancing flows. So from a theoretical perspective, this is a very good video for you to really get a grasp of. So let's just say that the US equity market here in the S&P 500 did better and did outperform Europe by 5%. So that will make the portfolio 5% longer of dollars than it was at the beginning of the month. And that is going to put managers in a tricky position, especially those that are passive portfolio managers like index funds, etc. And the reason being is because the currency exposure that they would have at the end of the month would have been altered. And if they really want to maintain this same currency hedge radius, they will have to sell the extra dollars and buy euros so that they can actually bring the overall fund back into balance. Okay, that's how it works in theory, and how orders are going to be executed as a function of how overweighted or underweighted they are in particular currencies. Okay, now these hedges are also going to be dependable on the geolocation of the portfolio manager. For example, a US portfolio manager that is invested in US and European stocks with a 50% weighting in each geographical location, and a monthly performance of, let's just say, 50% in US stocks at the end of April, as an example, and 10% in European stocks, it will have by the end of the month a total portfolio value with the US dollar denominated investment that have increased, and also the European investment that have increased. Now, since this portfolio manager is based in the US, the base currency there is the US, so there's no need to actually hedge the US, but there's going to be a need to actually hedge the euros because the European denominated investment has also increased. So if it went up 10%, they're going to have to sell 10% of euros. Okay, so hopefully you get this point. Now, as another example, if under the exact same premise, which is the performance is being 15% and 10% respectively in the S&P 500 or in the US stocks and European stocks, but the manager this time is based in Europe. Well, if that's the case, there's going to be a need to sell the US dollar and not the euro, because this manager is going to have the euro as the base currency. And since the US stocks have actually gone up 15% that month, they're going to actually have a need to unload dollars so that they can maintain this same currency hedge radius. All right. Now, if for whatever reason you are located outside these regions and you're invested in euros and US dollars, then you're going to have a need definitely to be hedging both currencies. All right. So there's three important takeaways here. Number one is that in global portfolios that are going to be actually employing currency hedges, investors are going to be selling the currency of the better performing region, since rising asset values require additional currency selling to actually maintain a target hedge ratio. That also is going to be dependable on different regions, and even if you are based in the US and in Europe, there might be a few tweaks where you see yourself selling even your base currency. As I said, I don't want to get too complex, because otherwise this is going to be a whole different subject, and we're going to go for a much more extended period of time in this video. So that's the first takeaway. Okay, you have to understand that there's this need to actually either buy or sell currencies, because we have to maintain this currency hedge radius. Second takeaway, if my experience is anything to go by, I'd say that these flows rarely change the underlying direction of the market, but can definitely cause some serious wobbles in the forex market, to the extent that they can easily disrupt some positions at the time that they hit the market, especially if you're holding these positions by the end of the month. And the third takeaway, last but not least, is going to be you have to definitely be careful out there when trading currencies, and you have to account for these erratic moves by month end and quarter end. Okay, this knowledge will help you not to be caught by surprise if a move that is hard to rationalize or is happening out of the blue hits a particular currency. Okay, so to me, those would be the most critical 3 takeaways that you can start to incorporate so that it enhances your awareness about this punchy movements that we're going to see by the end of the month in particular currencies, as we did in the euro or the pound or even the Swiss franc, as you see here in the orange line in the last 4 p.m. London fix. Okay, so hopefully this video has been helpful for you to build up your knowledge as it relates to the month-end rebalancing flows, and I will be back with more videos, more educational videos next week. Cheers.